Good afternoon, everyone. Thank you for joining today's webinar, Proposed Changes to the Community Reinvestment Act, CRA, and what it means for rural America. My name is Dan Stern. I'm HAC's Communication and Outreach Manager. I am the host and moderator for today's call. If you have not already done so, please ensure that you have access to both the audio and video portion of this webinar. To access the PowerPoint for today's call, please follow the link on your meeting confirmation and reminder emails. All participants are in listen-only mode, which means your line is muted. However, we are very interested in your questions and feedback. To submit a comment or question, please use the Q&A box on the lower right-hand side of your screen. We will answer as many questions as time permits at the end of today's presentation. Today's webinar is being recorded. Both the recording and presentation will be available on HAC's website, www.ruralhome.org, by the end of the week. I see a lot of familiar names today, but for those of you that are not familiar with the Housing Assistance Council, HAC helps build homes and communities across rural America. Founded in 1971 and headquartered in Washington, D.C., HAC is a national nonprofit dedicated to helping local rural organizations build affordable homes by providing below-market financing, technical assistance, training, research, and information services. We wanted to, in case you have not heard, HAC's Rural Housing Conference is rapidly approaching. This event brings together around 600 rural housing and community development practitioners, researchers, experts, and advocates for nearly 3 days of training and networking. I invite you to follow the link that you see on your screen, www.ruralhome.org/conference, to learn more about the conference and be directed to our registration site. And we hope to see you there. I'm going to introduce today's presenters. First, we have Evelyn Immonen. She is a Research and Policy Associate at HAC. We also have Lance George, our Director of Research and Information, and Keith Wiley, our Senior Research Associate. And I am going to advance on to Lance. I'm going to turn it over to you to get us started.
Thanks, Dan. Well, I'd like to reiterate Dan's welcome and thank everyone for joining us in this discussion and dialogue on upcoming changes to the Community Reinvestment Act and what it means for rural America. I personally think the CRA means a lot of different things to a lot of different people. Again, to me personally, the operative word in CRA is actually community. I think it should work for all communities, not just certain communities or communities with certain organizations or financial institutions in their communities. It should work for all communities. I also think there's a perception or a misperception that CRA is not as relevant in rural areas in rural America than it is in other communities. And there's no doubt that there are some structural and probably some non-structural components to CRA that keep it from fulfilling its full potential in rural communities. But we really want to, and the proposed rule probably has some promise and potentially some peril or pitfalls to advancing CRA in rural America. We're still trying to figure that out ourselves. But we wanted to kind of engage you in this dialogue and really had 4 major goals for today's conversation. The first of which is just to help you understand the proposed rule and what's being asked to be commented on. One of the primary components, many of you, this is very in the policy realm. Some of you may be very familiar with it, others not. We just wanted to give you a brief overview of some of the highlights. We can't cover all the material because it's somewhat of an extensive proposed rule, but we want to give you, again, some of the highlights. The second major part is we really wanted to focus on the rural components and where this intersects with rural America. There are a lot of conversations about this proposed rule out there today, but to the best of my knowledge, there aren't that many that are focusing on rural America and what it means for rural communities. So that was another primary goal. The third part is you. We really want to hear from you to help inform our comments. We sit here in Washington, D.C. largely, and while we've done a lot of work and research and background on this particular issue, we really need to hear from you because you're operating in communities, you see how it interfaces, and that's really important, so we need to hear from you. And the fourth and final goal would be that the OCC, the entity that is issued this proposed rule, hears from you. We really need them to hear from you It's hard to underestimate how important these specific comments are. There are going to be a lot of comments, and they need to hear from people working in the communities who have experience with CRA or who need CRA to work in their community. So you'll hear this over and over in today's discussion, but the comments are due on November 19th, and we really need for you to comment. And finally, just a brief word on this particular element or this particular focus. This is the advanced notice of the proposed rulemaking. So I don't want to be, we don't want you to be lulled into thinking this is, for lack of a kind of a bad analogy, this is a dress rehearsal or an exhibition match because it's the advance notice and it's not the actual proposed rule. It's actually really important, and in many respects can be more important where the rule is not as solidified yet, so you have more of an opportunity to weigh in on what's included. So just wanted to reinforce that we really want you to comment, but this is probably the best opportunity because when the proposed rule comes out, it might be more solidified. Probably this is more akin to loose concrete as opposed to set in stone when the final rule comes out. So with that, I'm going to turn it over to our experts, Keith and Evelyn, and thank you again for joining us. We look forward to the discussion.
Okay, thanks, Lance. Before we get started, I just want to do a poll here to get kind of a feeling of everybody's comfort level with the CRA. I know if everybody could just chime in here and let me know. I know I personally didn't know a whole lot about it until I started doing research. I'd read about it a lot in policy circles, but I hadn't really delved into it. And now I actually like it a lot. So, but I'm a data guy, and so but just to see, I guess I get a feel here. Most people have looks like, well, it's split a little bit: basic, novice, intermediate. That's good. There's a wide range, it looks like, of understanding of it, and there's a lot there to understand. It has a big impact, and I think it potentially could have even maybe a bigger impact down the road. So it's 5, yeah, that's pretty good. Actually, there's some good bit of intermediate. That takes a lot of work. Okay, I guess we can shut it down now, I guess. And what I'm going to do here first is before I'm going to just go into a little bit of background. I see there's a good bit of knowledge here, but I'm just going to, as context, just put 5 minutes on what the CRA is, and then I'm going to get into just some general, the couple of areas I think are the main focus with the APR. And first, just some background. The CRA was enacted in 1977, and generally it was, I think, to combat redlining and disinvestment in urban areas. There was actually in the 70s 4 pieces of legislation: the Fair Housing Act and the Home Mortgage Disclosure Act, and the CRA was one of them to address financing and access to credit and housing. And the legislation essentially requires federally insured depository institutions, and this is banks, not credit unions. It's FDIC insured lenders, and it requires them or recognizes the obligation that they have to meet the entire service area's needs, and particularly low and moderate incomes and neighborhoods. And the idea was back then that and it's still some today, I think, that maybe there might have been lenders who were taking deposits and weren't making loans in those areas. And so in order to implement this, the legislation charges the federal bank regulators, and today that's the OCC, the Office of Comptroller of Currency, the FDIC, and the Federal Reserve System, with evaluating and rating depository institutions on the degree to which they fulfill these obligations. And the way they do this is through the periodic CRA exams, and they're generally, most of them are based on asset size, although you can do a strategic plan where the small banks are assumed their test is less rigorous than the large banks. And throughout the process, the regulators first make a list of the upcoming examinations available to the public, and they're essentially seeking public input. And I think this is a big part of it, right? That you can comment and give information and stuff, and have your say so essentially in these evaluations. The exams essentially, they review activities in the lender's service area or assessment area where they have their bank branches. And the regulators do identify low and moderate income and distressed and underserved census tracts, and what they're looking for is like qualified activities in these areas are highly valued, and essentially they're looking, even like mortgage loans and stuff, to low and moderate income applicants. That's essentially would represent serving communities that might not be served. And when they do the evaluation, ultimately the outcome is there's a four ratings, CRA ratings. It's an outstanding, a satisfactory, a needs to improve, and a substantial non-compliance. And regulators actually, can consider these whenever a bank applies for something like a merger or a bank branch opening. They're supposed to look at the evaluation. Essentially, that's the incentive, right? If you get one of those needs to improve or substantial non-compliance, it could hold up an application for a merger or an acquisition. And so I think that's generally how it's set up. I think in the general terms, I know it sounds straightforward, but as we all know, it's a little more complicated than that. But I think oftentimes what I hear here, and like working with the data and stuff, is that the CRA doesn't really matter in rural areas. And I agree, as Lance said, that maybe there isn't, especially like community investment and development money related to the CRA that does occur oftentimes, not as much as probably should. But actually, what most people don't know is the majority of the institutions that are subject to the CRA regulations, really the FDIC insured lenders, are actually headquartered in rural and small town areas. About, as the figure shows, about 55%. Now, these are small banks. They have the less rigorous exams, but nevertheless, they are headquartered there. And the large banks like the Wells Fargos, the Bank of Americas, the Fifth Thirds, they actually do lending in rural areas too. So this regulation does touch financing in rural communities, even if we maybe don't see as much community investment and development that we think maybe could go there. It is important, and it's something that I think there should be maybe more of a focus on. Now, the OCCs APR, it's like 20 pages. There's up to 30 questions, but they propose the APR essentially as understanding is put forth as a modernizing of the CRA. It was created in 1977, so they're looking at modernizing it. And there's a lot there, but it generally tackles 3 areas. The first one is they're talking about moving more to a quantitative evaluation, more of an actual just calculation. That's how your score would be, like, kind of put it into a calculator and get a number, and that's how it would be done. They're also talking about changing maybe the assessment areas to include other areas. A lender can, because that's a big component of it. And the third part is also potentially expanding the types of activities that a lender could receive credit for, or that would be looked at. So it's very extensive, right? It's looking at the actual exam itself, how it's calculated, how it's determined. It's looking at where you're going to be evaluated on, and also the types of activities. So this is really a large part of the CRA is they're looking for comments on, right? And possible changes too. Now, the first part is potentially moving to a more quantitative based measure, right? Currently, the exams or an evaluator, they look at a bank at 3 different tests. There's the lending, there's the services, and there's the community development investment test. Now, this depends on the size of the lender. The small banks only do the lending, and the large banks do all 3. But generally, there are evaluators evaluating the banks on those 3 parts, and the most important one is the lending one. But the evaluators from the OCC or the FDIC or the Federal Reserve are going to review documents from the bank or an outside sources on the activity, and then they're going to rate them in each one of these and ultimately give a final score, whether they're outstanding, satisfactory, needs compliance. And then they're going to produce the report that you can access online. It's called a PE, or Program Evaluation or Examination. And it'll explain how they arrived at it after looking at these documents and looking at the context. And what the proposal is that they want to move it more to a quantitative approach, as opposed to the examiner looks at these and there's more qualitative aspects to it. They want to move it more to an actual, potentially a metric-based approach, right? And this, I think, comes from the APR, and I think it does a good job. They give an example of what something like that might be, right? This could be like if this was a single measure, right? A bank with $1 billion in total assets that, say, conducted $100 million in CRA qualified activities in the aggregate would receive a 10% ratio, right? And then what happened is that ratio would be compared to a threshold. So maybe the threshold was 9, and between 9 and 15 is satisfactory, so they get a satisfactory rating. So essentially taking it as almost just be a calculation, as opposed to an evaluation maybe from an examiner where there'd be more qualitative aspects. And one of the potential things, and again, as Lance said, I'm there's really there's no talk about impact here necessarily. I'm going to point out things that maybe you might want to consider when you're looking at this. And one of them is you could see where a rule might limit community involvement, right? It could, if it was just a calculation, it might just come down to the determination of what the numerator and denominator is. And you could also see where if it was a single rule, I think potentially it could further maybe minimize rural activity. If we looked at it all in the aggregate, it might just be easier to do more lending activity in suburban areas, and so it could further minimize that. But I don't think there's any doubt that it would be maybe easier to determine the score this way. Uh, but ultimately, I think one of the things to think about when you're responding to this is it might be difficult to capture how well a lender is meeting the financial service needs of their assessment area with a single measure. And I actually just went and I pulled an exam out just to show something that might not be picked up in something like this. It was an exam, and at the end of the exam, the PE document, it says, we took into consideration the limited opportunities for community development participation in the assessment area when completing our analysis. Now, something like that might not be able to do that with an actual metric. So that's some of the things to think about where a metric might fall short, right? That in that case, they looked at it and they said, well, there wasn't many opportunities, so was part of their evaluation. So that's but there is a large section here that talks about that potentially moving more towards a metric-based approach. Another section looks at another part looks at expanding assessment areas, and assessment areas are where a bank is going to be evaluated on, and they basically are where their bank branches are located. And that goes back to 1977 when a lot of the activity was related to where people took deposits, is where they made loans. And they're only really evaluated on the activity that occurs there. Now, I'd be remiss if I didn't say that under this current definition, it does, I think, kind of limit activity in low-income rural areas because fundamentally you need a bank branch. And in a lot of these areas, like maybe say in the Native American lands, there might not be any bank branch. So there is potentially, that some limiting factors. And here's a note, I think, in the APR is they say that an updated approach to defined assessment areas could allow a bank to include additional areas tied to the bank's business operations. It'd be areas where the bank has a concentration of deposits or loans, non-bank affiliate offices, or loan production offices. And so, this might mean they would expand what they could count as their assessment area, and they could account activity occurring in there, right? And one of the things I think, if you're thinking about this, what it could mean is it could limit the importance of bank offices and in-store services, right? Because now that's essentially the predominant determinant of where an assessment area is, what they're evaluated on. So it could limit that, I think, if we expand it out to include other areas. But in rural areas, it is true, I think, that the current system maybe doesn't work as well. And in fact, bank branches are declining in number. And so you could see where the assessment areas will probably need some kind of maybe to be looked at a little bit differently. I know in the case of bank branches, most of the ones that close are in suburban and urban areas, but in rural areas, when 2 or 3 bank branches close, it does actually have a dramatic impact on the overall number. And so I think in the case of expanding or altering the assessment areas, one thing I think to consider would be if anything that would be done would that it would include underserved and distressed rural areas, if it could expand activity there, but also at the same time preserve bank branch activity, because I think any changes you don't want to necessarily limit activity or limit the importance of bank branches, because many people need bank offices, but at the same time, if the assessment area there's something could be done maybe to expand to underserved distressed rural areas, increase activity, that would be a way to think about it. And the last one is expanding the types of CRA eligible activities. Generally, the exams, the evaluator looks at retail and community development lending and investment activities. And what they're focusing on, I think, is low and moderate income areas and activity that occurs there. And in just general terms, the examiner, is going to apply guidelines to determine which activities are going to receive consideration, right? And so oftentimes what you hear, and I hear this too, is that there's maybe a lack of clarity, or somebody is upset that one thing was accepted by this examiner or maybe not the next one, right? And so what the APR talks about is expanding the types and actually maybe potentially clarifying the types of activities that would be acceptable or would be evaluated. And I put this in here, pulled this out of the APR. It says, under what circumstances should consumer lending be considered as a CRA qualifying activity? For example, should student, auto, credit card, or affordable price small dollar loans receive consideration? If so, what loan features or characteristics should be considered in deciding whether loans in these categories are CRA qualifying? And so I just pulled this out. To me, this, what they're saying is, should they consider these activities as, under CRA? In other words, are we going to now look, you can in some cases do this, so they're going to look more at different types of consumer lending, like a student loan or something, or spell them out a little bit. And I think one of the things here is, uh, if you broaden the number of activities that are actually accessible, I don't know that that would necessarily by itself increase investment if you broaden the activities that you count. I mean, so that's one thing to think about. Just because now we're going to count a certain activity, it might not really mean that we're expanding access or investment in an area. So, that those are kind of in some ways two different things, I think. And I think the second point is the biggest point, that you want to be sure that if they do spell it out more specifically or start looking at other things, and I think everybody should pretty much agree on this, but that it's a high quality, affordable service, that we don't expand it to include stuff that maybe doesn't serve lower moderate income uh, neighborhoods and applicants and borrowers, or that we don't start including activities that necessarily might not be sound or might not be good for the community. But I do not disagree that maybe some increased clarity could help. With the CRA, sometimes it can be a little unclear, but these are the areas in general they're talking about. The first is, and they're very important. The actual measure itself, is it going to continue to be, they want to make it more quantitative where it's more metric based, so like a numerator, denominator, and a calculation. And also expanding assessment areas. How are we going to, are we going to expand them to include other areas we're going to evaluate a lender on? And the expanding the types of CRA eligible activities. What is it they're going to be evaluated on? And these are really important. And like I think Lance said it best, I think it's important that people chime in and have their words heard about what's going on in their community, because you probably have thoughts about this, about the lenders and the activity in your area and what it may mean to you. And I think a change could be, it's going to affect you likely. So it's important that we get input from people if it does occur, or how it, and shape how it occurs. In some other areas I think of importance that are related to this, they oftentimes hear talk about maybe a more emphasis on minority neighborhoods. I know oftentimes people don't think rural is diverse, but rural actually is diverse. We serve many high needs regions and many minority areas in rural America. And I think maybe special consideration could help, because a lot of times these are some of the communities that do, have lack access. So that can maybe be a consideration or something to think about, because the access can be very limited. Um, Nearly all lenders currently pass the CRA exam. And so, maybe a more nuanced way of looking at it, or maybe it should have more degrees so we could get a little more information. I think 98% pass it now. And another one is the treatment of bank affiliates. I think currently as it stands, when a bank's getting evaluated, they decide whether they'll count the activity from their affiliates, and it's up to them. So sometimes they will and sometimes they won't. It just seems like maybe that could be cleared up. I think, it's, when it's going to count and when it's not, it should just be kind of maybe just clearer. And the last one I think is really important, is that the CRA exam is considered when a lender applies for other activities, basically, because that to me is one of the primary incentives of the CRA. I mean, the baseline one is, if you do well, if you're a lender, you can tell people and that you're serving your community. And I think that is a good thing, right? And people will want to hear that. But also, if or if the banks and the community know that it'll be considered whenever later on, if you're applying for something, I think it provides another incentive. And I know sometimes there's talk about, maybe altering that some. And I think that, I'm not necessarily opposed to that, but I think it should probably be thought about as an incentive and considered. And I'm going to turn it over to Evelyn. Those are just some other things I think are tied in. But again, I think the important areas are the metric, because we're going to talk about how to measure it, the assessment area, and the activities that we're going to look at. So it's a really big thing and needs your input. So thanks. I'll turn it over to Evelyn now.
Hi, yeah, thank you so much, Keith. So I just wanted to go over, with those of you listening, several key resources that we at the Housing Assistance Council have available to help you write your own comments. A couple of years ago, HAC did a 3-part series on the CRA in rural areas. This research includes a robust report on the CRA and mortgage lending in rural communities, as well as a Partnerships and Opportunities for Rural Investment document, which first looked closely at banks who had received an outstanding on their CRA exam, and then had a set of case studies focused on examples of successful rural CRA projects. There are several more reports from HAC relating to CRA, which you can find on our website, but I do want to point out also our rural data portal, which can find information on a variety of housing characteristics based on national, state, or county data. For outside sources on CRA, we have here a link to a recent Treasury Department report on CRA reform, which is really good. And then there are also plenty of community organizations who have done really great research on this issue, and one of them is the National Community Reinvestment Corporation, or NCRC. Finally, HAC's comments will be publicly released in early November, so look out for more information on our website about our comments. Now, what does the timeline look like for CRA reform? The date all of you need to remember most is that the comments for the Advanced Notice of Proposed Rulemaking are due to the OCC on November 19th. The APR, Lance said this earlier, that's where the organizations really get a chance to shape new regulatory proposals. Then the OCC will need to review public comments. So they are currently expecting over 10,000 comments, at least. So it's important that we make sure that rural communities are part of that conversation. Then leadership in the OCC, we know, is trying to expedite this process, and so they estimate coming up with a final notice of proposed rulemaking sometime next year. That might change based on the political situation, and we do hope to also see the Comptroller working more with the FDIC and the Federal Reserve, which are the other institutions that involve enforcing CRA, before they release their final proposed rule. And that's all, folks. So thank you for listening in. We hope we made this process more clear to you. Another reminder that comments are due to the OCC on November 19th. So you can find the link to submit your comments on this page. And just, again, we at HAC really believe that it's important to have the government hear from rural America. The CRA impacts banking, it impacts underserved communities, it impacts rural communities. So we hope you'll consider submitting a comment. And we, at this time, are going to be taking questions. So if anyone has any questions.
All right, everyone. As a reminder, if you have any questions, the Q&A box in the bottom right-hand side of your screen. I have a question here, and this is for any one of our presenters. But are the other two federal bank regulators, FDIC and Federal Reserve Bank, also seeking comments on the CRA changes?
I could not right now that we know of. Yeah, the FDIC and the Federal Reserve. A lot of times they'll put out joint filings about it, where they'll, like where they're going to do regulatory changes. They try to do it in concert because they're all three enforcing, essentially the CRA. They're implementers of the CRA, and so they often do. But at this time, I have not. They haven't so far. I think it's just the OCC. That doesn't mean they won't when they do the final regulations. I think an important thing here to talk about too is Evelyn mentioned the Treasury did also chime in on this and release a really good report about modernization earlier this year as well. Now, they're not a direct regulator, but I think there's some good things there to read if you're thinking, you want to comment or helpful. But yeah, as far as the regulators, so far it's just the OCC, but later on I suspect that could change and you could get involved, the FDIC or the Federal Reserve, because they're all going to implement it and they try to keep it, they try to work together, although not always.
Okay, thanks, Keith. Another question I'm seeing here is, are banks examined or evaluated on the assessment areas?
But I'll take they are not actually examined on them. There's general parameters that are set out that they're supposed to use and apply, but they're not examined on them. It's they're supposed to draw them in such a way as that they don't limit their low income area and moderate income areas. And currently, and this is a big point I think in this, currently they're primarily based on the branch locations and so the assessment areas, and that's a big thing for rural because oftentimes there aren't, and well, not oftentimes, but a lot of times, like say in some Native American lands, there aren't bank branches. So that does, I think, tend to maybe hurt some of the communities as far as CRA activity, because if you don't have a branch there, you don't have assessment area there, and lenders aren't going to be involved necessarily. They're not going to get CRA credit for activity there. They aren't examined on them, but I think it's important, and that's an issue. That's probably maybe the most important thing in this, or one of the most important things in this for rural communities is if you're thinking about writing on this, about the assessment areas, think about what does that mean for you as far as trying to get CRA related, maybe, funds a bank to do it there, because it is currently based that way. And if there is a change, what might it mean, and stuff like that, because, that's an important issue because essentially that's where it's like the test, that's what they're tested on. So.
Okay. One other question I'm seeing is it bank branches or deposit-taking facilities, including ATMs, when we're assessing?
Well, it is. I think it's deposit-taking ATMs, and actually, technically, the way it's written, it says also areas where they do a substantial amount of activity, which would, kind of open it up for changes, right? But yes, it is deposit-taking, I think, locations, and so yeah, it's primarily offices and branches. When I do this, like when we study it, most of the time, what I do is to estimate an assessment area. What I do is I find the deposit-taking bank branch data from the FDIC, and then I find out what census tracts it is in, and then I generally use that as a definition of a lender's assessment area. But yes, it is deposit-taking, but I think the important thing is there is in there some language about substantial amount of activity, I think. And also, it'll be important as the number of bank branches are declining, how this will change or how it will evolve. I find it fascinating myself personally, because I'm still afraid to bank over the phone. So, but what this may mean and what it'll mean for the CRA.
Okay. Thanks, Keith. I have one more question here. What is the biggest factor limiting the CRA's effectiveness in reaching rural areas?
I I would say it is related to the assessment areas. Fundamentally, I think what happens is most of the banks that are primarily in rural areas are small banks, and they have the small bank exam. And so they don't require to do large community investment and development projects. And those mainly have a lot of their branches and a lot of their stuff in local communities. So they don't have the same requirements on them that, say, a larger bank does. And when you have a larger bank, they cover huge areas. And I think a lot of times the rural part's a very small part of what they cover, say a Wells Fargo or a Bank of America or a Fifth Third or something. And so I think it's because it's a small part, there just isn't as much activity going on there. And for the banks that would be concentrated and be more of like an expert in those kind of communities and directly serve those communities. They're smaller banks and they don't have the same requirements. So it's kind of in a way I think structural. I think a little bit that serves to limit the amount of activity that occurs there. That it's just there's not if those small banks they don't have to do it, then maybe don't have the resources to do it really. And then the larger banks, some overwhelming. We've done some reports on this that I think Evelyn talked about. And that the big banks they do rural activity, but the overwhelming majority of it's in suburban or urban areas, and so I think they're the ones that are required to do it, and I think then most of their activity ends up being done in those areas as opposed to rural areas. So it's I think those are that's probably the biggest reason.
Okay.
Thanks, Keith. This is Lance. In between questions, I might like to make one additional point that I wanted to hold back until we got over the material in the proposed rule. The first of which is I'd like to thank Keith and Evelyn for doing an amazing job. This is a relatively complicated topic, and kind of condensing this information into really understandable. I know it's very helpful to me, and it's going to help us form our comments. And I would also just really want to reiterate that you yourselves need to comment, but also please feel free to comment to HAC to let us know how we could shape our comments in relation to what you're experiencing or your needs. I would want to focus on one other element, which we'll probably try to incorporate in our comments, and that is don't feel constrained by the questions or the particular language in the ANPR. Feel free to write your own comments, how CRA works for you, regardless if they're addressed in the ANPR or not. So we think that's important. They might be overlooking some elements or might not even be aware of them. So we just want to reinforce that you don't feel constrained by the actual language in that. We want to hear from you and ideas that you might have about CRA and what it does that might not be particularly or explicitly stated in this proposed rulemaking. Again, I just wanted to focus on that. And also reiterate, we didn't give you a lot of HAC's position today. We wanted to provide a general overview. We are still formulating our comments. Again, it's a relatively complicated topic and nuanced, and it has a lot of diversity. But we will be putting those out, and we hope that this is an iterative process. Don't hesitate to contact us if you need more clarification or if you'd like us to stress certain elements. So I just want to make that point in between any questions, Dan, or any more information that we had.
Yeah, I completely agree with what Lance is saying. I think it's important that the input from people who are actually out in the communities, and because a lot of that stuff, especially in rural areas, there may be something or some way you have a look at things that are different and probably needs to be part of this, because this is important, to have your say so here. I think if you don't, then maybe it's almost like it never occurred. So it'd be interesting to see the comments, and you can shape, and this is a case where you can maybe shape policy, or it's important.
All right, so it looks like I have one more question here, and it's as OCC is leading this, is there a distinction on the entities that OCC regulates as compared to what other agencies regulate?
Yeah, the OCC is basically if you're a bank, whoever regulates you is based on where you're chartered. And the OCC is going to handle national chartered banks. I think it handles most of the big institutions like, Wells Fargo and that. And then the Federal Reserve Board and the FDIC, they're going to handle state chartered banks. And I think the FDIC does most of the examinations actually. It's really interesting if you were thinking about or applying to this. You can actually go online and you can read some of them, and you can just see what they're, how they go about doing them with the demographic data. But yeah, it's whoever regulates you is based on where you're chartered, and it can change. There used to be a lot of talk about banks, essentially regulator trying to move to another regulator. But yeah, so like that's why you'll have the OCC does some, and the FDIC does some, and the Federal Reserve does some. It's based on the charter of the bank. Essentially, I guess that's who has the oversight of the bank then, wherever it's chartered to operate or how it's chartered to operate.
All right, everyone.
And also,
sorry, go ahead, Keith.
Oh, just one thing. Oh, go ahead. I was just going to say it's also the exam types and everything. There's a lot of material in the CRA papers that give you a little more detail on like the types of exams and stuff like that that are administered. Because if you read the APR, you'll see them talk about some, and you can also read about them in our reports. Just give you a little bit of background.
All right. Well, if we have no further questions, then I would like to take this opportunity to echo Lance in thanking our speakers, Evelyn and Keith, as well as Lance himself, for their excellent presentation. I know I certainly learned a lot. As a reminder, the recording and materials from this training will be posted on HAC's website, which is www.ruralhome.org, later this week. I'd also like to take this opportunity one last time to give you one more pitch to consider attending our conference. It's on December 5th through 7th in Washington, D.C., with pre-conference activities on December 4th, and you can find out more at ruralhome.org/conference. Once again, I'd like to thank you for joining us for this webinar, and we hope you enjoy the rest of your day. Take care.